Michael, a swing trader, built a $200,000 portfolio in 3 years. He impulsively bought Tesla at $300 before earnings. The stock dropped to $280 after the report. Instead of taking a $6,000 loss, he sought revenge. Day 1. Doubled position at $275 on margin. Stock fell to $265. Portfolio down $35,000. Day 2. Liquidated all to buy more Tesla at $262. Stock rallied to $270, felt vindicated but still down. Day 3. Stock plunged to $250 on production delays. Down $85,000, he went all in on weekly Tesla puts. Day 4. Tesla announced a major contract unexpectedly. Stock rocketed to $290. Puts expired worthless. Total loss. Saint Vuitton. Set 0. A margin call for $40,000 arrived. Everything liquidated at a $192,000 loss. He lost 96% of his portfolio. He sold his car to cover remaining margin debt. His relationship ended. He suffered severe depression, requiring hospitalization. Revenge trading turns markets into personal battles. The market is indifferent to your emotions. It will destroy those who abandon risk management. A $6,000 loss became a $192,000 catastrophe. This was due to cascading decisions. Trading became about ego, not strategy. Michael reflected on his catastrophic choices. He realized the market doesn't care about feelings. Discipline prevents emotional trading disasters. He vowed to manage risk, not seek revenge. He understood the high cost of ego-driven decisions. Michael started rebuilding wiser and more cautious. He learned that humility is essential. He focused on strategy over emotion. He embraced risk management. He recovered, valuing discipline. He found success again.